The analysis report we're looking at today covers the massive 56% one-day jump in Agape ATP Corp, or ATPC, stock. It lays out the technicals, the momentum, and some cautious trade scenarios.
Yeah, the baseline is excellent. You can see the technical skill right away. But to really make this report hit home, we need to talk about a pretty big disconnect between how it's packaged and how the trade is actually planned. Let's start right there.
Okay, so we're starting with angle and tone.
Precisely. The report's overall tone and framing create a significant disconnect between the urgent hype it uses to pull you in and the very cautious conclusion it reaches.
I see that tension immediately. The hook, the visuals, they're all designed for that high-octane excitement. You see phrases like, one of the craziest moves, this question about a legendary short squeeze.
And that big squeeze overlay on the graphic.
Right. Sure, proud. But then the advice at the end is, incredibly restrained. Do not chase it if it's already up another 20%.
And that great line, let it settle, find support, and trade the setup, not the hype.
Which is fantastic advice.
It's perfect advice. But that tonal whiplash, it can erode trust. If you're trying to attract a serious technical trader, the packaging can't just scream clickbait. This analysis is way too sophisticated for an opening that just plays on market hysteria.
It feels a little like it's trying to have it both ways, maybe. Draw in the FOMO crowd with the flashy title, but then give them responsible advice later on.
Exactly. But you have to ask, does that really serve the goal? Think about it from the reader's perspective. They see this craziest moves headline and then get advice that's all about patience. They're going to wonder, are you selling me analysis or are you just selling me a click?
So the suggestion is to align the tone of the opening with the sophisticated and risk-averse focus of the actual trading plan.
Yes, ground the urgency in data, not just emotion. You want to keep that energy. A 56% move is urgent, but you anchor it in metrics.
So what would that look like in practice?
Well, for starters, you could adjust the hook. Instead of focusing on how crazy the move is, you could say something like a critical volume event just triggered for ATPC, ripping it up over 56% in one session.
Ah, okay. Still high energy, but it immediately centers the conversation on data.
Exactly. It's about what happened and what to do, not how it feels. And that extends to the visuals too. That squeeze overlay.
Yeah.
Change it to something more analytical, maybe ATPC, key levels defined, or even a question like momentum or trap. It just signals a more serious, objective dive from the get-go.
And that would mean being more clinical about the levels themselves.
You've got it. That resistance at 17 cents, it's a key level, for sure. But calling it the wall adds an emotional layer that isn't necessary. Just state the number. Let the technicals do the talking.
Okay, that all makes sense. Consistency of voice.
It strengthens the core message. Trade the setup, not the hype.
That actually ties in really well with the second point we wanted to discuss, which is how the report frames the fundamental risk of this stock.
Oh, this is a fascinating area. So the report correctly IDs this as a pure momentum play. Retail volume, all that. But it dismisses the fundamental business context without using that dismissal to really hammer home the extreme risk here.
I agree. It mentions the businesses health supplements and green energy, and then just says, frankly, right now the fundamentals don't matter.
Which is true for a day trade.
For a day trade, yes. But it's a huge missed opportunity. The absence of fundamentals isn't just a neutral fact. It should be, weaponized as part of the risk analysis. For a day trader thinking about sizing, that's maybe the most important piece of information on the page.
It is. When there are no fundamentals, the trade survival depends completely on those technical levels. That support becomes existential. And the analysis has the smoking gun right there, that December 12th management statement.
Where they basically said they had no idea why the stock was moving.
Right. No material developments. That's the ultimate risk metric. It's hard proof that this move is completely untethered from reality.
So the suggestion is to actively incorporate that lack of fundamental support and that specific statement into the risk calculation itself. Use it to strengthen the case for the downside levels.
Yes. You need to transform the dismissal into a justification for extreme caution. So, for example, you could explicitly state that the entire analysis is built on a zero fundamentally supported thesis.
Ah, okay, that reframes everything.
It does. It elevates that 13-cent support level or the 12-cent failure signal from just technical floors to existential metrics.
That's a great way to put it. Because with a blue chip stock, if it breaks support, institutions might step in and buy the dip based on the business value.
Exactly. But for a microcap like this, if 12 cents fails, there's no safety net. There's nothing underneath that price but empty air and, management silence. The risk is total and it's immediate.
And linking that risk directly to the management statement makes it so much more concrete.
It does. When you detail the bear case, that potential gap and trap, you link it directly to that December 12th statement. It confirms for the reader that a drop isn't just a technical failure, it's a justified return to a price that makes sense, which is probably much, much lower.
It just adds a whole other layer of intellectual rigor to the risk section.
And it tells the sophisticated reader why the stop loss is absolutely non-negotiable here.
Okay, let's turn to the final phase of the analysis then, the forecasting scenarios.
My concern here is really about injecting bias where objectivity is key. The labels, bull case, the dream, and bear case, the reality check. That's a problem.
I see that. You use a word like dream, and you're immediately implying the upside is, what, fanciful? Unlikely?
Right. And then you call the downside the reality check, which subtly frames it as the more probable or the more rational outcome. It biases the reader before they even look at the numbers.
The 17-cent break versus the 12-cent failure?
Exactly. And it directly contradicts the main thesis of the report, which is to trade the setup, not the hype. Using emotional labels encourages the reader to apply an emotional filter. You want the technicals to do all the work.
So the fix here is to adopt neutral operational language for the two cases.
Precisely. Eliminate the judgment. Instead of those emotional labels, use titles that just describe the technical action, something like continuation scenario and retracement scenario.
Or maybe even uptrend confirmation and volume exhaustion.
Even better, those are objective. They immediately link the outcome to something you can actually see on a chart.
And it helps the reader connect the scenario to a condition, not an abstract idea.
Yes, and then you can reframe the bull case itself. It's not some flight of fancy to 25 cents on FOMO. It's the high-volume target zone, and it's predicated on a clear, sustained break of that 17-cent resistance.
So the focus shifts entirely to what must happen for the target to even be in play.
You got it. I'd probably restructure that whole section. Present the technical conditions first, holding above 13 cents or breaking below 12 cents. Let those conditions be the case. You don't need to dress them up with fancy labels.
By cleaning up that framing, the entire document becomes a more neutral, objective toolkit, which is exactly what a good trading analysis should be.
It ensures the goal of trading the setup, not the hype, is baked into every single part of the analysis.